Hello, this is Gauri. Today's topic is sources of finance. The main finance decisions are financing decision, investing decision and dividend decision. Financing decision relates to raising funds through various sources of funds. In this chapter, we are going to discuss various sources of finance for corporate world. Let us begin our discussion with various types of sources of funds. According to environment or place from where one can get a source of finance, it can be classified into two ways. First is internal finance and second is external finance. Internal finance means the sources of finance which we can find within the four walls of the business. Finance is raised through inside the business and is called internal finance, like family, friends, customers, creditor sales, etc. Second is external finance. External finance is exactly opposite to the internal finance. The finance which can be raised from out of the business parties like shareholders, debenture holders, banks, financial institutions, etc. According to the time period for how many days or months or years one can get sources of finance, it can be classified into three types: short term, medium term and long term. First is short term finance. Short term refers to the finance one may need for one day or 1 year. It covers all the types of finance which is available within 1 year period. All the sources which for up to 1 year are available from individual business, industry and institutions are short term type of finance. Even the instruments prevailing in the money market is also a type of short term finance. Second is medium term finance. Instruments which are for the period of not less than 1 year period of time and not more than 5 year period of time, finance raised from such instruments is called as medium term finance. Third is long term finance. Long term means the finance available for more than 5 years. Anyone investing or borrowing the money for more than 5 years period in any instruments available for financing a long term is called long term finance. We can easily understand the combination of all types of sources of finance with the help of a graph. Now, let us discuss the short term sources of finance. First is advances from commercial banks. Loans and advances are the two terms which are used interchangeably, but the term loan refers to amount lended by a bank to a borrower for a specific purpose and for a specific period of time where the money is disbursed and it is repayable in installments. While advances on the other hand is a credit facility within 1 year largely for short term purpose to the borrower on the condition of repayment. According to the section 29 of Banking Regulation Act 1949, advances are to be shown in three major groups. First is demand loan, cash credits and overdrafts. Second is bills purchased and discounted, and third is term loan. A demand loan is a loan which is repayable on demand either in lump sum or in one time or as agreed by the bank at a short notice. Demand loans are short term loans which can be raised for the purpose of payment of short term liabilities or maintaining liquidity or working capital. Term loan on the other hand is a medium and long term loans granted for a longer period for the special purpose and repayable in installments of fixed amount. Housing loan, car loan, educational loan, loan to purchase assets, renovation, expansion loans are the term loans. Cash credit is generally granted on pledging or hypothecation of stock of goods. The borrower is allowed to withdraw according to his requirements and interest is charged on the actual amount withdrawn. Overdraft is a temporary arrangement in which the customer is allowed to overdraw his current account up to a specified limit. Interest is charged only on the actual amount overdrawn. Moving further to next point, that is public deposits. The main function of the bank are to accept deposits from public and to grant advances to the needy persons. The deposits are classified as: first is fixed deposit or term deposit, second savings bank deposits, and third is current account or demand deposits. Fixed deposits or term deposits are the deposits which cannot be withdrawn before a fixed period. Naturally, a higher rate of interest is allowed on such deposits. A deposit receipt is issued to the depositor when he deposits the money under this scheme. Second is saving bank deposit, and it is meant for salaried persons or small businessmen. Interest is naturally at a lower rate on such deposits. Withdrawal are allowed either by withdrawal form or by checks with a certain amount of restriction. Current accounts or demand deposits are generally for businessmen who require to deposit and withdraw facility frequently and require no restrictions on deposits or withdrawal of money irrespective of number of transactions. Interest on current deposits is lowest among the three types of the deposits. Now, what is treasury bills? Treasury bill is a promissory note issued by RBI on behalf of government up to a period of 1 year. It is generally issued at discount and repayable at par. Therefore, margin between discounted value and par value is the income of the investors. Presently, RBI issues treasury bills for 91 days, 182 days and 364 days maturity period. Though the treasury bill is short-term money market instrument, it is a source of finance for government. Fourth is a commercial paper. Commercial paper can be issued in the form of promissory note when corporates or financial institutions are in need of short-term money. They issue commercial papers for a period of minimum 7 days to maximum of 1 year. Though commercial paper is the money market short-term instrument, it is traded on secondary over-the-counter market, and all the reporting related with commercial papers are presented to Fixed Income Money Market and Derivatives Association of India. Fifth is advances from customers. Advances from customers are received when any goods or services ordered but not yet rendered or delivered. The cash or check received in advance is referred as current liability if it is for a period up to 1 year. If customers are not using the cash or delivery option in online shopping, they have to pay advance money prior to receive goods or services through debit card or credit card or net banking. In case of face-to-face shopping, when customers want to book their orders of goods and services they want to purchase, they give the advance cash to the seller. Sixth is trade creditors. All the times goods or services may not be possible to sell for cash. Sometimes to increase the business profit, businessmen have to deal with suppliers or creditors to provide some grace time period for the payment of purchase. In the same way, businessmen also have to provide certain time period to their customers or debtors for the payment of sale. In this case, a seller becomes the trade creditor for the purchaser. In this transaction, till the credit period is not over, no interest is charged by the supplier, but the purchaser also does not get the benefit of the cash discount at the same time. Now, let us see what are the medium term sources. Medium term sources are bills receivable, account receivable, hire purchase and leasing. First is bills or notes receivable. Bill is a small chit written by a seller who sells goods on credit, and buyer agrees with all the matters written in the same chit with his signature. Bills in a legal document with a stamp, and seller can claim the money after the maturity period of the bill or expiry of credit period allowed to the customer. In the same way, if there is promise given by the customer himself, his own side in writing on same type of chit, it is known as promissory note. Most sellers prefer to write bill or take a promissory note when they are not sure about the customer's financial position and want to minimize their bad debts. Second is accounts receivable. It is the most outstanding receivable from day-to-day transaction. It is a normal receivable of the money that occurs from regular credit sales to customers. Accounts receivable is a short-term source of finance. Third is hire purchase. When a buyer purchases any asset by making payments in installments, it is called hire purchase. Under hire purchase, user is buyer and he intends to get ownership of the asset, but the ownership of the asset is transferred only after paying all the installments or full price. Individuals and small businessmen use the way of hire purchase for purchasing an electronic or mechanical items like refrigerator, washing machines, air conditioner, automobiles, etc. by paying some percentage of cash price in advance as a down payment and remaining amount in installments with the interest as agreed. Fourth is leasing. In leasing, the user of the assets undertakes the assets on rent, which is known as lease of an asset. Under the agreement of lease, the owner of the asset gives right to use the asset for a specified period of time against a payment of lease. In case of leasing, the owner of assets is called lessor, while the user of the asset is lessee. Lease financing is most popular for leasing expensive assets like business machineries, buildings, computers, etc. Now, let us discuss long-term sources of finance. Main source of long-term finance are shares, retained earnings, debentures and loans. Shares. The term shares refer to sharing the source of fund in terms of capital. In the business of sole proprietorship, owner of the business himself provides capital for his business. In the business of partnership, partners jointly provide capital for their business, but in company form of business, promoters and general public contribute to capital as share capital of the company. The total capital of the company is divided into uniform units of small denominations and each standard unit is called as share. Thus, a share is a fractional part of a capital of a company which forms the basis of ownership and interest of a subscriber in the company. There are two types of shares widely used by the companies. First is equity shares. By investing a money in terms of shares, if holders of the share become the owner of the company, then it is known as equity types of share. Equity shareholders are the real owners of the company as they contribute to the capital of the company. That is the reason that equity shareholders have right to receive a benefit from remaining all the reserves and surplus of the company. Second is preference share. Other than equity shares, company also prefer to issue preference share as a source of finance. Investors of preference share also receive dividend at fixed rate as return on investment, just like as equity shareholder. The only difference in preference shareholder receive dividend with fixed rate of return and preferential rights over equity shareholders in terms of receiving their capital and dividend in arrears at time of winding up of the company, but they cannot claim as owners of the company. Moving ahead with retained earnings. Retained earnings is internal source of finance. When company uses the amount of its own reserves and surplus for certain period in its own business, it is known as retained earnings, which is also a source of finance. By using retained earnings, the company does not require to go outside to collect fund, but it uses its own money which is retained out of business profit every year. Next is debentures. Debentures is a borrowed source of finance for the company. When company wants to raise the capital by paying the lower cost of capital than shares, the company uses the way of issuing debentures in borrowing terms. Debenture is a borrowed security issued by making payment of fixed interest as cost of collecting the capital, just like as fixed rate of dividend payment in case of preference share. Last is long-term loans. In the same way of debenture, loan is the capital raised by a company by borrowing the money from bank or any other financial institution for a limited period of time on fixed or variable type of interest. Though long-term loan is an easy way of source of finance, company has to provide some security in terms of assets, investments or securities. We conclude the session with remark that today we have discussed various sources of finance for a business firm for different